Hello members and welcome to the Fat Profits Macro webinar. My name is Roger Malik, your host for the webinar today. And joining us is of course our special guest, founder and CEO and our fund manager, Angus Geddes. Angus, welcome to another webinar. How are you today?
Hi Roger, yeah, very well, thank you. How are you?
Oh, very well. I look forward to these sessions every Thursday with you, and I think today's one is going to be very informative. I really enjoyed reading your fat chat today, and I think we'll break it down for our members and hopefully get some information across. So before we get started, a little bit of disclaimer: all our presentations, including today, are general in nature. We don't provide any personal advice. If you're looking for that, please see your financial advisor. And also, past performance is no indicator of future performance. We have a Q&A session towards the end of today's webinar. So if you've got any questions on the macro, on the big picture, anything moving the markets in general, we're happy to take those questions and clarify anything for you. So let's get into it. First thing first, a quick market update, snapshot of what we're going to discuss today. So these are the key headlines. So we will look at the tactical rally call that Angus made in today's fat chat, running with the bulls. We'll also look at the US inflation numbers, a slowing China, the bank loan demand, oil, iron ore, gold, and US dollar. We'll also have a quick look at the Australian budget, which was announced a few days ago, positioning of arguably world's best investor, Warren Buffett, and look at what he's doing with his funds, and that's quite interesting. Of course, we'll look at the ASX and the S&P 500 and the Federal Reserve versus markets, a bit of a history lesson on that as well before we take some questions. So as you can see, we're prepared, plenty of topics to discuss, hopefully enough for you to get some ideas from. So first, looking at the market snapshot from last week to this week, NASDAQ leading the way. So the tech stocks in NASDAQ, including Alphabet overnight, continue to go higher. Dow Jones, ASX sort of consolidating, the rest of the markets as well, a bit of up and down movement, but nothing to write home about. Moving on, we're going to start today with US before we go into Australia. So we'll paint the picture for you, Angus, and our members. As you know, Federal Reserve have raised rates very aggressively over the last 12 to 14 months, and now over 5% increase in the cash rate, and they're really trying to slow down the economy. And one of the key goals is to break this tight labor market, but unfortunately that's not worked yet. They're still going to be working hard to make that happen, but the unemployment numbers are actually going the opposite direction at 3.4% at the moment, so at a historical low, whereas the inflation, which just came out 24 hours ago, the headline number has gone down to 4.9%, so just under 5. And if you look at the core inflation, that's sticking around at 5.5%. It's been like that for about 4 months. So before we look at the S&P 500, Angus, and you've got some very good information to share with us today, can I get some insight on your thoughts on the inflation number, which just got released last night, and your anticipation on where it's likely to head?
Yeah, so look, I think the inflation in the United States is decelerating, and we saw the year-on-year rate drop from 5 to 4.9, and the market's take on that was, it wasn't 5.1 or 5.2, it was 4.9, so it's trending down. That's got to be good news. However, in terms of the underlying trend in inflation, it's hard really to come to the conclusion that it's decelerating at a rapid pace. It's not just falling off a cliff. And one of the things that I sort of thought would happen with inflation this year is that it would come down, but it would be very sticky once it got into the 4s and the 5s. And of course, at that level, it's still very much going to be a problem for the Federal Reserve and their efforts to bring down the inflation rate back down to target below 2%. So my take on it is, it's going to be quite a long fight. It's going to be pretty stubborn and sticky to bring it back below target. And there's a lot of different subcomponents that make up inflation that are proving to be really quite sticky. One of which is that labour market and that unemployment rate, which dropped to 3.4%, and it's not going up. So we're continuing to get wage growth coming through, and this is keeping up with pressure on the inflation rate and stopping it from falling back to 2% in a quick manner. So that was pretty much my take on it.
Yeah, no, that's a good point. Yeah, look, that unemployment number has been proving to be a thorn in Federal Reserve's flesh. So time will tell over the coming months, but usually it's the last shoe to drop in historical terms. But look, let's have a look at the S&P 500 first before we look at some other stats, because this is quite interesting, Angus, as you said. Yes, the market reacted favorably to the overnight news, but also we're continuing the short-term uptrend. And you had a very interesting take on the market today in your daily note to members. So please shed some light on how you see the S&P 500, both in the short term as well as the longer term.
Well, look, in the short term, and it was a hard note to write today, because I had to really sort of think about. I've been thinking about it for a while in terms of the price action. But if we look at the technicals and ignore the fundamentals, let's not focus on the fundamentals, but just look at the technical price action on the S&P 500. This chart is pretty bullish, and we've got a succession of higher reactionary lows, and we've got a top line resistance at 4,200. And when I look at the bias in the market at the moment, which is to the downside, the bears have a bias to the downside. It's we look at positioning. Cash levels are high, liquidity is in abundance. You've got the largest amount of shorts by hedge funds on the S&P 500 since 2011. There's a pretty strong bias to the downside. Markets habitually have the opposite, tend to do the opposite to what the consensus believes is going to happen. And whilst we know that fundamentally, it's big risks, I think, for one, I'm in Stanley Druckenmiller's camp, and also Warren Buffett. I think the US is going headlong into a recession. I think it's going to be a hard landing. But between now and when that recession materializes, we may see the market wrong foot just about everyone with a surprise move to the upside. That's what this chart is telling me. And of course, we know that if the S&P 500 were to get above 4,200 in a reasonably convincing manner over the next 2 or 3 weeks, we know there'd be an enormous amount of short covering that would go off. A lot of hedge funds who are short would be forced to cut their losses and reduce their hedges. A lot of short covering in stocks would be carried out. And of course, on the long side, you'd probably get a lot of cash coming in from the sidelines. So, in a nutshell, it's a very confusing market. It's technically sending the opposite signal that you would expect. And I'm not just talking about our view, but some of the best known, most highly regarded analysts strategists on Wall Street have been confounded by the price action in the S&P 500. But we have to respect the technicals. And between now and when the US recession does arrive, and I think it'll be a hard landing, I don't think it'll be shallow, we could see the S&P 500 break through 4,200 and rally to the upside. Now, I've got to caution, Roger, that this is a tactical call. I'm not saying that we're long the S&P 500. The S&P 500 is yet to break out above that 4,200 level. We're yet to see that, but that's the way it's looking. So rather than rush out and buy a whole lot of stocks, I'm not on this side, on this scenario. I would prefer just to be quite neutral and run a fairly neutral sort of position. And in our SMA managed account portfolios, we're still holding between 20 and 30% cash. which is high for us. I'm quite happy to continue to do that. And knowing that if the market does have a move to the top side, well, we've still got plenty of equity exposure. I still believe that we're going to get this final drawdown in the bear market, and that the bear market has more work to do. But between now and then, there might be a tactical rally, and we just have to be aware of that and aware of the risks. I think for hedge funds who are massively short, this is potentially could be a big problem.
Yeah. So that's very good points there, Angus. So just so we're clear for members as well, so what you're suggesting is like a short term, we might see this continuation of this uptrend if we break past 4,200 points, and we might see that for a few more months before we see the sell-off towards the later part of this year when the recession finally arrives. But in between now and then, you're not putting any more cash in the market. You're not chasing this rally. Is that what we're hearing? So you're going to keep your cash.
To be very clear, and I'd encourage everyone to read the note today to get my view. But to try and make this as clear as I can, I think there's upside tactical risk in the S&P 500, right? That it could break out above 4,200. A short covering rally could ensue. We could see cash coming in from the sidelines. That could actually push the market to 4,500. This is the opposite of what all the strategists on Wall Street expect. But I'm saying that this cannot be ruled out. I don't think for 1 minute this means that there's going to be no recession in the United States. I still think there's a recession coming. We've had a record amount of tightening and upside adjustment to interest rates. We've got the worst inflation in 40 years. So I don't think that the fundamental picture has changed at all. I think there's a recession coming. But between now and when that recession arrives, and when we do get a potential, if we were to get that final leg in the bear market to the downside, we might find that the S&P 500 actually does quite well in the month ahead. I could be completely wrong, and the market is yet to prove that on the 4,200 resistance level, which it's got across. But and that remains to be proved. But what I'm saying is, with this bias to the downside, the fact that so many investors are positioned now for a drawdown in the market, which hasn't been coming this year, we now have to be cognizant that the market could move higher before an eventual move lower. And what I'm advocating is, I'm not advocating rushing out to buy the market for 5 or 10%, which may not materialize. What I am saying is, if you're sitting on cash, just be patient, be disciplined, wait for the opportunities. Now, one of the greatest investors of all time, Stanley Druckenmiller, said this week, he's doing exactly that. The market's quite confusing. He's running a neutral position, knowing that the opportunities will be there. And I think that, if the market does break out to the upside, and it does drag the indices higher, then that just increases the downside risks to later in the year. So just sit tight, stay defensive, be an observer, not a participant. And I think there'll be a better long-term buying opportunity that materializes either later this year or early next year. I actually think it'll be later this year.
Later this year, yeah. Very good, Angus. I think that's very clear. And look, we have to respect the trend, as you said. So the trend for the time being just continues to inch higher. One quick question I'll take before we move forward, and we'll take more questions towards the end. But this one's from Jeffrey, saying about the hard landing stance. He's saying, what are the factors which will create that hard landing in the US?
Sorry, Roger, what was it again?
He's saying, what are the factors that will create the hard landing in the US?
Okay, so I think at the center of all of this is interest rates. So the bond market's looking for rate cuts because it believes a recession is on the doorsteps. The equity market's looking for rate cuts and no impact on growth. So we've got a dichotomy there. But I think the Fed are not going to be cutting interest rates this year. I think they are absolutely determined to bring that inflation rate, which is coming down, but at a very slow pace, as we saw last night. They're determined to get the inflation rate back to 2%. So for now, that means holding rates for higher for longer. And we can't rule out that there won't be one more hike down the track. And I think that is going to have a material impact in terms of slowing the economy. Secondly, consumers' balance sheets are not what they were after the pandemic. Savings have been run down. We've seen spending, artificially inflated by a lot of the money printing that the government did in the fiscal stimulus packages. I think that's all beginning to unwind. So I think it's, tougher times for the consumer. Thirdly, I think the Fed's of the view that the unemployment rate's got to be higher, and to get the inflation rate down, and to really get that, put wages back in the box. So we've got to see that. And I think, in terms of a hard landing, I don't think it's a 2008 type of recession, but I think it's going to be a lot harder than what the consensus currently expects. And I could see a 20% drawdown in corporate profits in the US, which would probably translate to a material drop in the S&P 500. I think the unemployment rate will have, a 5 in front of it, not 3.4. I think a lot of the overhiring that's been going on for the last few years, a lot of that is going to unwind quite rapidly. And, I think we're seeing that with savings. Consumers are just not going to be spending what they were spending in the last few years. I think that's all got to unwind from the pandemic. So, I continue to hold quite a high conviction view that the US economy will be in recession. If we look at this long-term chart, Rog, what's sort of clear to me is, if we look back over the last 15 years, the S&P 500 has had this nice rally. It was at the top of the trend line. It's middle of the range at the moment in terms of that trend line. And what we probably will see, and I've got a high conviction that we'll see a drawdown in the US stock market that will bring it back down and test at least those top October lows sometime this year. But between now and then, we can see this 4,200 resistance wall. The market is climbing a wall of worry. It's not really reacting. It's had negative news after negative news thrown at it. It's not going down, which says to me that this bias to the downside might be about to get wrong-footed. And with a breakout above 4,200, effectively flushing out all of that bearish positioning. And of course, that would sort of make the market even more vulnerable to a downward leg should recession arrive.
Very good, Angus. Look, we know we talked about it last week as well. The final sell-off in every bear market is usually the strongest and the deepest. So that's where the cash will come in handy. So we still advocate holding on to cash for that time. Moving on to other topics now, Warren Buffett, arguably the best investor of all time, has recently dumped $13.3 billion in stocks. And I'll just read a couple of quotes from this article. Is now basically increased the exposure in cash and the treasuries in Q1. And he's raised his cash reserves by $2 billion to now $130 billion in Q1 2023, which is the highest level since the end of 2021 when equities entered a bear cycle. So I guess he's really looking at short-term treasury bills and bank deposits where he's getting close to 5%. And look, a lot of investors are doing that at the moment. Money market funds are receiving a huge chunk of money, Angus, and we've talked about in the last 2 or 3 webinars. And Warren Buffett is no exception. He's doing exactly that.
Yeah, look, this is a great point, Roger. The world's most successful investor of all time sitting on cash. He's not rushing out there to buy anything. In fact, he's been a net seller. He's unloaded 13.3 billion of equities in the last quarter. He's quite happy taking 5% on US treasuries. Stanley Druckenmiller, one of the best hedge fund managers of all time, exactly the same, running zero risk, net risk in his portfolio. Quite happy to have his money in short-term money market funds and run very low risk until we get clearer signals about where the economy and where the stock market is going. He's waiting for that sell-off. Both of them are waiting for that sell-off. We're in that camp, but I guess what I'm saying today is, there could be a tactical rally. Traders, might be able to take advantage of it if, if the index were to get above 4,200. I think for most investors, the advice doesn't change. Have some cash. Don't get caught into being over-invested. Ahead of a recession, because it will arrive. It will probably take people off by surprise in terms of the economic downturn, and there is still unfinished business yet. But if we look at these, some of these market mavens, such as Buffett and Stanley Druckenmiller and what they're doing, I mean, we're pretty much doing exactly the same.
Yep, very good. All right, moving on to another little stat that you might find interesting is every time Fed pauses, and you'll notice the difference. So the black line is the S&P 500 and the green line is the 10-year treasuries, the bonds. So every time Fed pauses, markets typically go up, followed by bonds. But when Fed starts cutting rates, typically bonds outperform the S&P 500 because usually they only cut when there is a problem. And here's the big one. When Fed cuts and recession happens, you see a big drop in the S&P 500 and bonds rally. And this is the bear case. So if the Fed cuts sometime later this year, as the market is pricing in, or even early next year, most likely we would have seen a recession by then. So that's not the scenario you want to be holding all your eggs in the basket. So that's why we're suggesting holding some cash for that period, if and when that does happen. So this is quite interesting. Again, historical stats. But moving on to other topics. Sorry,
Roger, I just want to jump in on that slide.
Sure.
The other point to mention is that, on a 10-year bond in the United States, you're getting 3.5%. Yet the inflation rate is running at 5%. And so your real rate of return on an annualized basis is minus 1.5, assuming, inflation continues at the same rate. So it doesn't make a lot of sense to own a 10-year treasury bond at 3.5%, given where inflation is at the moment, and given that capital is at risk. If interest rates go up, which they could do, and the yield on the 10-year treasury bond goes up to 4% and there's no rate cuts this year, then you're sitting on capital losses, and that's, negative returns could be quite sizable, just as we saw last year. Whereas if you put your money into a short-term risk-free money market fund in the United States, you're going to get 5%, not 3.5, 5, and you'll get $1 return for every dollar you put in, plus interest. Whereas with the bond portfolio, you can get capital losses on bonds if interest rates go up. So bonds are no place to hide. And I think, just perhaps digressing over to precious metals, I think that's one reason why gold has done better this year, because it's providing probably a better, more insulated return on inflation.
Yep, absolutely. All right, moving on to other topics. So we know that the banking jitters still haven't gone away yet. We know the last bank to go under was First Republic. And following that, one of the key things that the Federal Reserve are looking at is the credit tightening. So the loan demand, and this came out only a few days ago, where the demand for commercial and industrial loans has continued to drop. And you can see that in historical terms, but it's now 46%. We do think this is still going to go higher in terms of banks tightening. It's currently 46% of banks tightening versus the prior survey, which is 44.8. So there is still, in the Federal Reserve's point of view as well, is still more to go, getting probably closer to 50 to 60% of tightening, which will help the Fed's case in slowing down the economy. So that's something to keep an eye on. The other thing which Angus published in his daily Fat Chat earlier this week was the earnings per share rolling 12 months. And this is the blue line. So the earnings per share are declining, but you know, there is still probably another couple of quarters to go before we can see that final decline in earnings, corporate earnings that is, versus the PMI, which is the manufacturing index, and that's also declining ahead of earnings. So this is something to keep an eye on. Again, you can see in prior recessions, this was quite deep as well.
No, I think, Roger, just jumping in here, you know, it's why the markets are so confusing at the moment. You know, the price action of the S&P 500, and it's a very narrow, it has been a narrow rally, but, you know, the price action has been confusing given the deterioration in these fundamentals. Yep. It must be very difficult, you know. It is a confusing, there's a lot of confusion going on at the moment. And you just imagine, I mean, I'm not saying the S&P 500 has a 100% chance of breaking out on the upside, but that's the way it looks at the moment, despite all of the confusion coming in from these leading PMIs.
Yeah, agreed, Angus. Look, we speak to a lot of members and investors, and yes, there is a lot of confusion out there, but of course, patience will be rewarded, and that's one of the key things we're suggesting. Moving on to US dollar, it's holding just above that support line, still above that 101 mark. And of course, gold is still over $2,000. What are your thoughts there on the greenback?
Yeah, the dollar didn't really like the inflation print, you know, off lower by 0.1%. And I guess that's because, you know, traders are basically recalibrating and lowering the probability that the Fed will put another rate hike in, or you know, we might get one more, we might not, but there's probably a lower probability given that the inflation rate did come down a little bit, and it also means that we're probably now very close to a pause. You know, the top of the rate tightening cycle. There's no guarantees, but that's the way it looks optically at the moment. So yeah, we have seen some weakness in the US dollar, and of course, you know, it's the dollar index continues to sort of flirt with this 101 support level. Is it going to rebound off that, move back towards the top end of the range at 105, or does it break below 101 and have another leg down? Of course, you know, if it did break down the US dollar, that would have probably quite bullish implications for commodities and precious metals in particular.
Yeah, and talking about commodities, well, gold continues to shine and look still hovering over $2,000 an ounce and within a pretty close distance of its all-time highs. Gold stocks continue to be, you know, heading in the right direction. And look, they're starting to certainly have very good levels of cash. If production levels continue to be pretty reasonable out of our Australian gold producers, we expect the next earnings update to be pretty strong. But overall, you're pretty happy with gold at the moment, Angus? You hold quite a few gold stocks in your SMAs.
Yeah, look, I am. I mean, you know, we have had a bit of renewed momentum in the sector. And as you say, a lot of the Australian gold producers are actually producing really good margins at the moment. One encouraging point to mention is back in 2020, when the gold price hit 2,000, every man and his dog was talking about it going to 3,000 an ounce. Similar behavior back in 2021, when the gold price, in the wake of the Ukraine war, got up to 2,000 an ounce. And it's interesting that, you know, with the gold price moving back above 2,000 this year, which is, you know, the third time, and pushing above resistance, No one's really talking about it. So that's good. It means that there's not a bias in the market for higher gold prices, which is what we want. You know, we don't want everyone all over this trade at this stage, at this, what I think is quite an early stage. You know, we want as few people as possible because, you know, that's what gives a bull market an impetus. You know, you don't want to be on a crowded trade. So I don't think it's getting crowded yet. So I think there's a good chance that the gold price can hold on to these levels and work its way higher over the coming year. And, you know, an added bonus, an added tailwind would come from the US dollar, perhaps, if it broke below that 101 support level on the index chart that we looked at before.
Yep, very good. All right, let's move on to Australia now, because something important happened earlier this week. I'm sure a lot of our members listening today would have seen the Australian budget got announced. And of course, every budget never pleases anyone, but I think there's some good things and some not so good things in this budget, as always. But one of the things was the budget was back in the black, at least for the time being, but it's forecasted to be in negative for the next few years. What were your thoughts, Angus, on the budget itself? And also, I think one of the key things they're looking at is dwellings in Australia, you know, and the new migration that is expected to be quite high, and there's worries about, you know, rising cost of rent and other issues. So, your thoughts?
I think the government had a tough time with the budget this year. You know, we've got a lot of people in Australia doing it quite tough with the inflation, with the rental and housing crisis, cost of living going up, and so they had to balance, you know, funneling some of those surpluses back into the economy and looking after some of those groups that are experiencing, you know, real and severe economic hardship. They had to balance that with putting money into the economy and risking what we had back in 2022 after the pandemic, with all that fiscal stimulus that got injected into the economy to prop it up, that we get inflation. You know, it's going to be a headwind for the RBA to try and bring that inflation rate down. You know, they're having a tough time getting it down, particularly in Australia. And, you know, so it may well mean that we're looking at higher rates.
Yep, absolutely. And more pressure on the households for at least with this migration coming up, cost of living.
Yeah, so just on that slide, you know, solving one problem, let's open the floodgates, let's let the migration in. That did solve one problem where we had an acute worker shortage. A lot of businesses and farms, etc., agriculture industry, many industries were doing it tough. So the migration is solving that problem, but it's leading to another problem, which is housing. It's forcing up the cost of living and rents, etc. So, you know, resolving one problem is leading to others, and it's not necessarily bringing inflation down.
Yep. Yeah, it's a bit of a double-edged sword, isn't it? So, looking at the ASX 200 now, how do you see the ASX now, given what we're expecting if the US markets continue this uptrend? Do we expect the ASX to follow?
Look, I think the first point, Rog, is yes, we follow Wall Street. So, you know, Wall Street fails to get through 4,200 and reasserts on the downside, which could be the case. And let's say recession arrives tomorrow and it becomes very obvious that it's going to be quite a severe downturn and Wall Street starts heading south at a great rate of knots. Yeah, we're going to follow that. But I think, like, given the positioning of the market, and, you know, if the S&P 500 does break out above that 4,200 level, seems to me like, you know, we will probably reassert to the top side as well. Although it will be harder for the market to get back to that record high without getting lift from the banking sector and the resources sector in Australia. So it's worth bearing in mind that, you know, iron ore price is down at around $105 a tonne. We've got the oil price at 72. So we may not see the resources provide the same sort of lift to get us back to a record high. So I think it's going to be a bit of a grind, to be honest. And I think, you know, with the banks sort of struggling at the moment, interest margins are under pressure. I don't see us having the same sort of dynamic to the upside as the US. The other point, the final point to make is we don't have the same amount of short positioning in the ASX 200 as we do on the S&P 500. So I think positioning is a bit different. And of course, valuation. You know, just as we said on the downside, Rog, I've made this point many times. I don't think we go down as much as the S&P 500 in the drawdown, just on valuation grounds. I think we are going to struggle to get back on the upside, you know, without some of those big mega cap technology growth stocks that the US has that we simply don't have.
Yeah, absolutely. All right. Thank you for that. Let's move on to China now, because I thought we might as well talk about China, because the reopening for Q1 in China was certainly a big part in you know, the rallies that we saw around the world markets, and it certainly propelled oil prices and many others, iron ore, etc. But we're going to talk about oil and iron ore in just a moment. But just looking at the China 300 weekly chart, and we also got a monthly chart as well in a moment. So the weekly chart is showing us the downtrend. How do you see the China reopening? Is it now finally slowing down?
Yeah, look, it's, you know, it's more, you know, more points really for the bears. I mean, the reopening hasn't been what everyone thought it was going to be 3 months, 4 months ago. When the CSI 300 got up to 4,300, we had that big sort of sugar high and that bounce off the 3,600 with the reopening. And we just haven't seen the economy really following through as strong as probably what a lot of economists thought 3 or 4 months ago. I mean, those manufacturing PMIs were really weak. We've got oil at $73. You know, that hasn't rebounded the way that a lot of people thought. We've also, you know, seen the iron ore price come down, and of course their imports were very weak this week. So yeah, I think you know, the damage to the property market in China has perhaps caused, you know, quite a lot of knock-on damage to the consumer, and so it's been a fairly muted recovery. Now, whilst I don't think the CSI 300 goes back to that October low, I think that was the definitive bottom. You know, it's yet to break that topside downtrend resistance, and you know, we might see, you know, depending on what the US market does, but you know, there might be one more downward leg before a new bull market in Chinese stocks is confirmed.
Okay. All right. And what about Hong Kong? Because yes, China is important to Australia, so we certainly have to keep a close eye on them. What about Hong Kong index? So that's a big market as well.
Yeah, similar story to China. You know, we have seen downtrend resistance broken with the green line, and I think 15,000, just as 3,500 was the low for the Chinese CSI 300 index. I think the lows are now in for Hong Kong, but it doesn't mean to say we might not see a bit more consolidation and raging to the downside before a resumption in the upward trend. We can see on this chart directly in front of us what looks to be a right-hand shoulder of an inverse head and shoulders formation. The neckline being the orange line. So, you know, time will tell. But you know, I think you know, a break above the 22,000 would be very bullish. But I think, you know, looking at this chart, I still think it's a bit early. You know, they're not quite out of the woods yet. The economy's not growing as fast as what people thought it would. You know, and there's still a bit of residual fallout from the property, you know, from the drop in the property market from a few years ago.
Yeah. Okay, great. And last couple of topics before we take any further questions. Iron ore, I think you touched on that earlier. Yeah, iron ore has come back to just above $100 a ton. Yes, we saw a big jump in the first quarter of this year from $80 to close to 130. So that helped a lot of our big iron ore producers like BHP, Rio, Fortescue reach new highs, but it's now come back down. How do you see this one going forward?
I think this is a bit of a flashing red light, really, about the China reopening story not being what it was cracked up to be 3 or 4 months ago. I just don't think China's economy is getting back on its feet in the way that most of us probably thought was going to happen at the beginning of the year. I mean, I thought they were going to have problems for a while, given the fallout from the property sector, and we can see it quite clearly with this iron ore chart, with the iron ore price breaking down to 106. We might see lower levels yet. It might get back down to the 90s. I don't think it'll take out the $80 level low that we saw in 2022. But I see weakness on the horizon for iron ore prices as the global economy slows into next year.
Okay, and finally about oil. You've touched on that earlier. It's now sort of consolidating as well, sort of mid 70s now. Do you see a continuation of this downtrend?
Well, it's yet to break the green line. It's really, it's continuing to consolidate and trade within this range. Ranges are typically quite good formations because stocks either being accumulated on the buy side, in which case you'll get a breakout eventually on the top side of the range, or stocks are being dispersed and sold, in which case you'll get a breakdown on the bottom side. I think if the US economy were to have a really hard landing next year, we're going to see that $60 level tested at the bottom of the range. The fact that oil has not been able to climb much beyond resistance at sort of $80, $84, despite the fact that OPEC tightened production and reduced supply to the market, just probably says, how it's a signal really how weak the global economy actually is.
Absolutely. All right. So on that note, well, firstly, just to summarize this, because we've taken a few questions and replied to them as well. So just to summarize, members, we continue to advise caution. Cash will still be very handy. Angus continues to hold between 20 and 30% cash in his SMAs, the managed accounts. So the advice is to, that Angus is going to continue to hold on to that cash, but there is a short-term potential of this uptrend to continue in the US markets and hold up the other markets around the world. So that's my take on how things are going. If you are a short-term trader and you want to get into this short-term uptrend, well, you may do so. However, be cautious with your stop losses, etc., and target prices. But all in all, if you're a medium to long-term investor, patience would be very good. Holding cash would be advisable, and waiting for those opportunities like Warren Buffett, like Stanley Druckenmiller, of course, like Angus, our fund manager. So that's my take on it, Angus. I'll pass it on to you to say your final words. But thank you once again.
Thanks, Rog, and thanks everyone for listening today. And we look forward to joining you same time, same bat channel next Thursday. Bye for now.